Bitcoin is once again testing investors' patience. The world's largest cryptocurrency continues to trade below the key $90,000 level, as financial markets enter a cautious holding pattern ahead of the U.S. Federal Reserve's next interest rate decision. Despite strong long-term optimism surrounding Bitcoin, short-term momentum has clearly slowed. Traders, institutions, and macro investors are choosing caution over conviction, waiting for clarity from central banks, geopolitical developments, and broader risk markets. At the time of recording, Bitcoin is hovering around $87,000 to $88,000, struggling to reclaim the psychological $90,000 mark that acted as support earlier this year. So, what's keeping Bitcoin stuck in this range? Is this calm before the next breakout, or a warning sign of deeper weakness? In this video, we break down everything you need to know. Bitcoin's current price structure, institutional behavior and ETF flows derivatives, and on-chain signals, macro pressure from interest rates and geopolitics, and what traders should realistically expect next. Let's dive in. Bitcoin price. Action stuck in neutral. Bitcoin's recent price behavior tells a story of hesitation. After rallying strongly earlier in January and briefly approaching $98,000, Bitcoin failed to maintain upward momentum. Since then, price action has softened, pulling BTC back toward the mid-$80,000 range. Over the past week, Bitcoin is down roughly 4%. It has retraced more than 10% from its recent peak, and volatility has noticeably compressed. This kind of movement often signals consolidation, not panic. According to market analysts, Bitcoin is not experiencing a collapse. Instead, it is digesting gains while waiting for a new catalyst to determine direction. Trading volumes also support this view. Spot market volumes remain subdued, indicating that neither buyers nor sellers are aggressively taking control. This lack of urgency reinforces the idea that the market is in pause mode rather than trend mode. In simple terms, Bitcoin is waiting. Market sentiment: defensive, not fearful. On-chain and derivatives data suggest that traders are becoming more defensive, but not outright bearish. According to recent market pulse reports, leverage across crypto markets has begun to cool. Hedging activity has increased, sell-side pressure remains present but controlled. This combination paints a picture of risk management, not panic selling. Traders are reducing exposure, protecting downside risk, and preparing for short-term volatility, especially around macro events like the Federal Reserve meeting. One important takeaway here is that confidence has not disappeared, but conviction has weakened. This is the difference between a market that is scared and a market that is cautious. Right now, Bitcoin clearly falls into the second category. Institutional signals, ETF outflows, raise questions. One of the most important factors influencing Bitcoin right now is institutional behavior, particularly ETF flows. In recent weeks, global crypto exchange-traded products have recorded significant outflows. U.S. spot Bitcoin ETFs have seen multiple consecutive days of net redemptions. More than $1.3 billion has exited U.S. spot Bitcoin ETFs in a short period. This represents a clear de-risking move by institutional investors. However, context matters. These outflows are not necessarily a rejection of Bitcoin itself. Instead, they reflect short-term macro uncertainty, higher interest rates, attractive yields in traditional markets. For institutions, capital allocation is relative. When U.S. Treasury yields sit near 4% or higher, Bitcoin must work harder to justify fresh inflows, especially in the short term. That said, longer-term positioning tells a more balanced story. Despite recent outflows, institutions continue to develop new crypto-linked products. Bitcoin remains included in diversified macro strategies. Major asset managers still view BTC as a strategic allocation. This suggests institutions are repositioning, not abandoning. Derivatives. Market. Event-driven hedging. Derivatives data offers another layer of insight. In the options market, short-dated implied volatility has increased. Longer-dated volatility remains relatively stable. This structure is important. It tells us that traders are hedging near-term risks, such as the Federal Reserve decision, macro headlines, political uncertainty. But they are not pricing in a long-term breakdown. In other words, short-term uncertainty is high, medium, and long-term expectations remain intact. This reinforces the idea that Bitcoin's current weakness is macro-driven, not fundamentally driven. The Fed effect. Why interest rates matter. At the center of all this caution is one key factor: U.S. monetary policy. Markets are overwhelmingly expecting the Federal Reserve to leave interest rates unchanged at its upcoming meeting. According to market-based probability tools, there is a 97 to 99% chance of no rate change. So why does the Fed still matter so much? Because it's not about the decision, it's about the message. Investors are listening closely for signals about future rate cuts, confirmation of higher for longer policy, commentary on inflation and economic resilience for Bitcoin. This matters deeply. Higher interest rates increase the appeal of risk-free assets, reduce speculative liquidity, raise the hurdle rate for risk assets. As one analyst put it, Bitcoin is no longer just a liquidity trade. It must increasingly compete on its own merits. This shifts Bitcoin's role toward a structural hedge, a long-term store of value, rather than a short-term momentum play, macro and geopolitics. Risk-off pressure. Builds beyond the Fed, broader macro forces are shaping sentiment. Investors are navigating geopolitical tensions, trade and tariff uncertainty, political risk in major economies, earnings concentration in large-cap equities. As a result, capital has rotated toward traditional safe havens. Gold has reached fresh highs. Silver has attracted renewed interest. Cash and short-term bonds remain popular. In this environment, crypto, including Bitcoin, faces headwinds. Not because its long-term thesis is broken, but because risk appetite is selective. This is a classic risk-off backdrop. Technical levels. What traders are watching. From a technical perspective, Bitcoin is at a critical junction. Key levels to watch. $90,000. A psychological and structural resistance level. A sustained break above this could revive bullish momentum. $85,000 to $88,000. Current consolidation range and near-term support. $84,000. A breakdown below this level could trigger deeper downside and renewed fear. $95,000 plus a reclaim of this zone would confirm trend continuation. For now, price remains trapped between support and hesitation. Let's summarize the competing forces in the market. Bullish case. Bitcoin's supply remains structurally tight. Long-term institutional adoption continues. On-chain data shows long-term holders are not panicking. Bitcoin is increasingly viewed as a macro hedge, bearish/cautious case. ETF outflows show reduced short-term confidence. High interest rates limit speculative upside. Macro uncertainty suppresses risk appetite. Momentum has clearly slowed. Both narratives are valid, which is why the market is stuck. What comes next? So where does Bitcoin go from here? In the near term, Bitcoin is likely to remain range-bound, volatile, headline-driven. The next decisive move will depend on Federal Reserve guidance, liquidity conditions, institutional re-engagement, broader risk sentiment. For now, Bitcoin is not collapsing. It is waiting for clarity, waiting for confidence, waiting for the next macro signal. And when that signal arrives, history suggests Bitcoin will not stay quiet for long.